Many traders misinterpret volume. They assume that when there are more green bars, that is, if there are more green candles forming here, then it indicates more people are buying the stock. And if the bar is red, then it suggests more participants are planning to sell. But this is practically not accurate. It simply cannot work like that. So what is the actual reality? How do you genuinely use volume? Let me tell you that volume is an extremely important factor. Whether you are doing intraday trading, swing trading, long-term investing, or in some situations, even if you are trading options, volume plays a role everywhere. After price, the most crucial element on a chart is the volume. So today we are going to learn in this video how to utilize volume in trading or investing, how to read it correctly, and how much it can support you in trading. Let's start the video. But before we continue, if you find this information useful, smash that like button, and if you're new here, don't forget to subscribe and enable notifications so you'll never miss our latest uploads. I'll see you right after the intro and disclaimer. So first of all, let us understand what volume means. Volume represents how many shares are being exchanged in a stock at a particular moment. That is, how many shares are being bought and sold. Now, think for a second whether you believe it is possible that more shares are being bought and fewer are being sold in a stock. Does that situation exist? If you think about it correctly, you will realize it is never possible for more buyers to exist and fewer sellers in a stock at a specific time. Because remember, shares are not constantly created like products in a factory. Shares are limited. So, if you want to sell your share, that sale will only happen when another person wants to buy. And if you want to buy a share, you can only buy when someone else is ready to sell. Meaning, if 10,000 shares are being bought in a stock at one moment, then those 10,000 shares can only be bought if 10,000 shares are also being sold. This means volume simply tells us how many shares are traded in a stock at a time. That is, how many are bought and sold. So now let us talk about how volume is counted and why understanding it matters. Suppose one person buys a share, and another person sells that same share, meaning this person sold it and this person bought it. So what will be the volume here? In this situation, the volume is not 2, but 1, because only one share has been exchanged. This is how volume is calculated. That is, if 1 million shares have been sold in a stock, then someone also bought 1 million shares. So the volume will be 1 million, not 2 million. Now that we understand how volume is calculated, let us understand its importance. The benefit is that if 10,000 shares are normally traded in a stock, that average volume remains 10,000. But one day you suddenly see 15,000 or 20,000 shares being bought and sold in that same stock. What would that indicate? It means something significant has occurred in the stock, because earlier the normal trading was 10,000 shares a day. But now it's suddenly increased. So we understand that traders or investors have developed a strong interest in that stock. When interest rises in a stock, the price has a greater chance of either moving upward or downward. Up to this point, we still do not know whether the price will rise or fall, and volume alone cannot determine that. Volume only indicates where investor interest is growing or declining. But once we identify increased interest, we can use that signal to analyze several important things. So now let me show you directly on the chart how to apply volume and how to read it effectively. I had already applied volume on the chart here. Now, earlier I told you that you need to recognize what the normal volume looks like and when volume becomes higher than usual. Checking every small bar manually to find which volume is high and which is low would take a lot of time. As soon as you confirm this, you will see a moving average line inside the volume section. Now, you can clearly see what the average volume is. If the volume bars stay below that moving average line, it shows the volume is currently lower than the average, meaning investors are not very active in this stock. And if the volume bars move above the moving average line, it shows the volume is higher than normal. So first, enable the volume indicator, open its settings, turn on the moving average line, and then simply observe. If the bar is above the average line, volume is higher than average, and if it is below, volume is lower than average. Now that you understand how to read the average, let us move forward and learn how to interpret it. Using volume and price together, only 4 situations can occur. The first situation is price movement. Suppose you notice that the share price is rising, and at the same time the volume is also increasing. For example, you can observe that the average volume line is here, and the bars are moving well above the average. This means the price is climbing, and volume is rising along with it. So whenever you see price moving upward with rising volume, it signals that the trend is strong because price and volume are advancing together. Since the price is moving upward, this behavior represents a strong bullish trend. So the first point is clear. If volume rises with price, the trend is powerful and bullish. Now, what is the second situation? If price is falling and volume increases, then it means the trend is strong on the downside. If the price is declining, the trend is bearish. Therefore, when price drops and volume expands, it becomes a strong bearish trend. You can see that volume is above average here, and alongside this, the price begins to fall, confirming a strong bearish move. After this, you can see how sharply the price declined. This completes the second scenario. Now moving to the third scenario. The share price rises but the volume declines, or volume stays around its normal levels. When volume decreases or remains average during a rise, it signals that the trend is weak. If the price is increasing, the move appears bullish but lacks strength. So it is a weak bullish trend. Entering positions in such conditions increases the likelihood of loss. For example, you may notice price rising, but below, volume remains around average levels. If you checked volume while seeing the price rise, you would avoid entering, but if you ignored volume and entered only because the price was rising, you would see the price drop later and face a loss. That explains the third scenario. In the fourth case, if the stock price is falling but volume stays below or around average, then because volume is lower or normal, the trend is weak. Since price is falling, it appears bearish, but a weak bearish trend means it can easily reverse. When price drops under weak volume, it may rise again soon. Trading in such conditions carries higher risk, but if a reversal signal appears, such as a candlestick pattern or chart pattern suggesting the trend might shift, then a reversal trade can be considered. For instance, you may see the price falling, and volume staying under the average line, meaning volume is weaker than normal. In this scenario, the trend loses strength, price dips slightly, and then reverses upward. This shows how volume helps us read the trend more accurately. You now understand these 4 setups, and by applying them at different points, you can greatly improve your trading approach. That's it, traders. Thanks for watching this video. Pressure is the point where most people collapse, but it's also the stage where real champions are forged. If this video helped you see things more clearly or pushed your mindset forward, make sure to tap that like button right now. And if you're new here, hit subscribe and turn on the notification bell so you're always early when the next lesson arrives. Keep your focus locked, your goals elevated, and don't let excuses stand in your path. The grind always tells the truth. Stay disciplined, stay sharp, and I'll see you in the next video.